file, okay? Do I need to file? Not everyone does, okay? If you are a corporation, you have to file every single year. It doesn't matter if you make money, you lose money, you owe money, or you have to pay, you're going to do a refund. You have to file if you are a corporation, okay? Trusts and estates, they have to file if their gross income is more than $600, okay? Trust guys are set up by grantors. They take, either money or property and put it in a trust in the care of a third party, a trustee, for the use of a beneficiary at some future date. And the idea is that you have this property, whether it's money, maybe a portfolio of stock, it could be a physical piece of property that's collecting rents. But if this property is sitting in a trust and it earns more than $600 in a year, that trust has to file a Form 1041, okay? An estate, we talked a little bit about estates in the last class. Again, an estate is when someone passes on, they leave behind whatever, money, property, jewelry, clothing, okay? Almost everybody leaves behind some sort of estate. We said that, look, for the most part, most of us aren't going to be affected. We're not going to have to file an estate tax return because you have to reach that $5.3 million number in order to be required to do that. But if you do have money or you do have an estate and maybe it's taking your executor a while to close out the estate, so this property is sitting there and again, maybe there's a portfolio and it's earning interest and dividends, or again, maybe there's a piece of property and it's collecting rents. If this estate earns more than $600, then they're gonna also have to file a Form 1041 for the estate, okay? Now, in the case of individuals, they may or may not have to file a tax return, okay? And there's 3 pieces of information you need to know in order to figure out whether or not they did, okay? The first one is you need to know their filing status, okay? You need to know how old they are. In particular, you're looking to see, are they 65 years of age or older? If they are, that's important. And then also, you need to know what their gross income is. This is the point in the reading guide where I will tell you start paying attention to the terms gross income, okay? As we start getting further into the chapters, you're gonna start hearing terms like gross income, taxable income, passive income, earned income, unearned income. I'm sure I can come up with a few more. You have to be aware of what type of income they're asking for. In this particular exercise, they're focusing on gross income, okay? When we get to chapter 5, we're gonna determine what gross income is. But in general, guys, it's gonna be all the income you've earned, everything that needs to be reported on your tax return before we take out any of your exemptions and deductions, okay? It's really gonna be this first part of the 1040, okay? So it's gonna be all the income you need to report on your return without having taken into account any deductions or exemptions that you're gonna be entitled to, okay? So gross income is gonna be the magic number. Now they put a chart on page 22 in your books, and they give you a bunch of different scenarios for thresholds. And they're basically saying if the taxpayer has gross income of more than this number, then they're gonna need to file a return, okay? But you don't need this chart. Again, if you know the filing status, the age, and the amount of gross income, you can figure this out. And you're gonna wanna remember this formula, okay? So the idea here is this, and if you want to flip to that last page on the sheets I gave you, you can go through this. So the filing status, guys, you're going to go pick your filing status, and you're going to go look for the amount of your standard deduction, okay? The filing status will determine what standard deduction they're entitled to. Their age, again, if they're 65 or older, they'll tell you if they're entitled to an additional deduction, okay? So if you're 65 years old or older, you don't just get a standard deduction, you get what's called an additional deduction. And again, it's on that back page. And then the gross income. So the idea would be, you add this. They're also entitled to, everyone's entitled to their own personal exemption, okay? So typically if you're filing a tax return, you are entitled to 80%.
Can you just say what filing status?
Filing status, you go and look for your standard deduction. If you're 65 years or older, your age, then you're entitled to an additional deduction. It's an additional standard deduction. And then you're entitled to what are called personal exemptions. Okay, so typically if you're filing a tax return, you're entitled to an exemption for yourself. And if you're married filing joint, you're entitled to a personal exemption for your spouse, okay? Taxpayers, we'll see when we get to chapter 4, are also, may also be entitled to dependent exemptions, maybe for your children, maybe for a relative whom you're supporting, okay? But those don't factor in. These are just personal exemptions. Myself, if I'm married filing joint, my spouse, okay? And you'll see on the last sheet there that for 2015, those are worth $4,000 each. So you're gonna add these up, guys, and you're gonna come up with some number, okay? And then the idea is to say, okay, look, if the gross income, the taxpayer's gross income is greater than the sum of X, then you have to file, okay? You are required to file. If you're less than, you don't have to file. Okay? You don't have to. But just because you don't have to doesn't mean that you're not going to want to, because the fact is maybe you went to work, maybe you had taxes taken out, that you withhold taxes from your paycheck, okay? So now the government's got some of your money. But now you're looking and saying, hey, I didn't really make a whole lot of money, so I'm actually due a refund. So you're going to want to file, even though you don't have to file, to get that money back. It's the only way you're going to get it back, is by filing, okay? So again, just because you don't have to file doesn't mean you're not going to want to file. If you're due back money, you're owed a refund, you're going to file, okay? But you don't have to if you want to give it up. Let's just walk through one, because again, this is kind of important. So if I told you guys that we had a taxpayer who's married filing joint, go ahead, sorry.
So, when you have filing status, if you're somebody's dependent, you don't get a standard deduction, right? So if you're not filing like single or independent or whatever, you're actually being claimed on someone else's tax return.
If you're being claimed on someone else's tax return, you're not going to go through this exercise.
You still have to file it.
You're talking about like if you, in certain cases, there are going to be an exception, which I'll get to. In certain cases, yes, you will have a child who will still have to file their own tax return, and you are entitled to a special standard deduction, which we'll get to in chapter 6. They're one of the exceptions to this rule, which I was going to list out in a little bit. You would still file a tax return, but you wouldn't follow this formula to see whether or not they file. Okay. Go ahead.
I didn't get a sheet.
There should be, there's a couple up here. There's one over here. If anyone didn't get some of the forms that I sent around, there you go. Okay, so let's just go through one exercise here and see without, I don't know if it's in the book or not, hopefully not. We have a married filing joint taxpayer. One of the two parties is over 65, and they have gross income of $23,000. Would they have to file? Married filing joint, one of the two parties is over 65, okay? And they have gross income in total of $23,000. Do they have to file?
No.
Yes.
We got the split. There's some saying no, and some saying yes. Okay. You're gonna walk through your formula, right guys? So married filing joint in 2015, they get $12,600, right? If you look at the additional standard deduction, we said one of the two parties is over age 65, so they're entitled to an extra standard deduction of $1,250. And because it's married filing joint, there's not one personal exemption, but there's two personal exemptions. So that's $8,000. Okay, so that gives us in total $21,850. And we said versus their gross income of $23,000. They have to file. Okay, they do have to file in this case. Okay, but that's the exercise you're going to walk yourself through. Okay, is everyone clear on this? Good quiz question. Okay.
We would have that chart, right? Or would we
No, I wouldn't give you the chart. I would give you the information on the last page.
like the explanation?
No, I would want you to remember the formula and say, if I asked you, I would just give you information saying you have such and such taxpayer, he's this many years old, he's going to file single, and he makes X amount of gross income. I would want you guys to remember the formula to figure out whether or not he has to file. What I would give you is the last page attached to that document, which is the amount of the standard deductions
That's what I mean.
and the personal exemption. That I would give you, but I would not give you this chart, okay, in the book. I would just give you the last page there. Okay, are we good? Okay. What I do want to point out on the chart, guys, is a couple of things here. If you kind of scroll down to where it says married filing separate, you'll notice that that is only a $4,000 amount. They only give the married filing separate person a $4,000 personal exemption. They don't give them any standard deduction, even though they are entitled to one. I'm going to tell you this is going to be a common theme. When you see married filing separate moving through the rest of the course, always kind of be wary. The IRS's rules when it comes to married filing separate always kind of clamps down. The limitations are much more narrow. You will see that if you're married filing joint, you get better exemptions. They give you better phase out ranges, meaning they allow you to make more money before they'll take away a deduction. You're entitled to more credits, okay? Whenever someone is married filing separate, everything becomes much smaller, okay? They're gonna deny them a lot of credits. They may not be entitled to a lot of different deductions. Why is this? The IRS truly, I mean, government in general, is a proponent of family units, okay? So they're gonna give you, again, better deductions, better credits, things of that nature. Personally, I think there's a lot more chance for manipulation when you have married filing joint, because you may have two taxpayers sitting down together and saying, well, I'll report this, and you report that, and you take this, and they can kind of manipulate their tax returns to their advantage to get the best sort of tax return that they can. So that's why I think, again, the IRS is denying them a lot of different deductions, a lot of different credits. And again, you'll see this as we keep moving through. And also, I think there's also the fact that, look, instead of having to administer one tax return, now they have to administer two tax returns, okay? So there's slight bit of a penalty, let's say, for doing married filing separate. And I'm just pointing out that this is gonna be a common theme as we're moving through the course. When you see married filing separate, know that the rules are probably gonna be a little different for those people, okay? The other thing I wanna point out on this chart is that if you scroll further down, you're gonna see surviving spouse with a dependent child. Surviving spouse, it's also called qualifying widower, is a status that exists for 2 years after the year in which you may have lost your spouse. So if I was married, let's say last year, and my spouse passed away last year, I would have still been able to do married filing joint last year. But in the 2 years after that year, I may, not definitely, may be eligible if I'm supporting children to file qualifying widower or what's called surviving spouse. And if you look on the last page, the chart I gave you, or in the back of your book, you will see that the qualifying widower, surviving spouse, actually shares the tax rate table with the married filing joint, okay? So they're giving these taxpayers the benefit of the married filing joint tax rates. But what they're not giving them, they're not giving them the extra personal exemption. So married filing joint, you're gonna get 2 personal exemptions and the good tax rate table. For qualifying widower, they're gonna give you the good tax rates, but they're only gonna give you the 1 personal exemption, okay? So if you see qualifying widower, yes, you're using the married filing joint tax table, but again, you're getting 1 personal exemption in that scenario. Just something else to point out to you, okay? And we'll get a lot more into the filing status and the tax tables, you know, and the exemptions in the next, when we get to chapter 4. Look, I mean, the book just points out, don't kind of get sucked into the trap of saying, oh, I'm due a refund, therefore I have to file a tax return. You can't look at whether or not someone owes money or is due a refund to determine whether or not they need to file. You have to go through this exercise, okay? Don't just say, oh, you're due a refund, therefore you have to file. You don't have to file if you're due a refund. You're gonna want to. You're not required to by law. And the other thing I was going to point out is that, look guys, this is a general rule, and almost everything I'm going to do in this course from here through the end of the semester is going to be the general rule. There's probably going to be exceptions to almost everything I say, but we're really, for the most part, going to cover the broad general rules. But there are some exceptions to this. As Shelley was pointing out, certain children who their parents are claiming them and taking their dependency exemption, they're not going to follow this exact rule. They're entitled to a special standard deduction, but because someone else took your exemption, you're not entitled to your own personal exemption. There's only 1 exemption per person. So if your parents are claiming it, you're not gonna be able to get it, so you won't follow this formula. If you have to pay the AMT tax, then you're still gonna have to file no matter what. Doesn't matter what this says, you're gonna file. If you are self-employed and owe taxes of more than $400, again, it doesn't matter what this formula says, you're filing, okay? So there are exceptions to this rule, but for purposes of what we're doing, this is gonna be the rule, okay? Is everyone good with this? Okay. We then kind of roll into due dates and extensions, okay? And guys, important, you have to know this stuff, okay? Due dates and extensions is very important. We all know that the due dates for individuals are April 15th. Hopefully we all know that, and most people just know that in this country. The due date is April 15th, okay? And technically the way it reads, go ahead. Okay. Technically the way the law reads is that the taxes are due on the 15th day of the 4th month after the close of the fiscal year, okay? As individuals, we use a calendar year because the code tells us that if we don't keep books and records, you have to use a calendar year. And as individuals, almost none of us are keeping books and records to run our households and our day-to-day expenses. There may be a few taxpayers out there who can justify using a different year, but for individuals, guys, 98, 99% of us are gonna follow that calendar year, so April 15th is gonna be the day, okay? Partnerships have the same rule, the 15th day of the 4th month after the close of the year. Corporations get to the 15th day of the 3rd month. They have a tighter time frame there that they have to file by, okay? With partnerships and corporations, be wary, okay? A lot of them are not on calendar years. They might have a fiscal year. So it's gonna be either the 15th day of the 4th month after the fiscal year, or the corporation, the 15th day of the 3rd month after the fiscal year. Look for a fiscal year if you're dealing with a partnership or calendar year, corporation, okay? Don't just assume it's gonna be April 15th or March 15th, because it probably won't be, okay?
So is it safe to say that if you file for an extension, you get 6 months?
That's what we're gonna do. Yes, okay, so in this country, at least anyway, individuals and corporations are entitled to an automatic 6-month extension. Automatic extension basically means you don't have to justify the reason why. If for some reason you just can't get it done, you just don't feel like it, you can apply, send in a form 4868, and you get an automatic 6-month extension. So for individuals, that's generally going to mean you buy yourself until October 15th, okay? Again, corporations get that same 6-month extension. Partnerships only get 5 months. I don't know why, but for whatever reason, they get 5 months instead of 6.
According to the book, then you have to pay on April 15th.
Yes.
So how does that work? You don't know how much taxes you're going to pay.
I will tell you, my husband used to go on to a partnership, and we don't get our K-1 until sometime in July. So I always have to mail in a form 4868. What you have to do is they will mail you generally, or whoever's sending you information late is going to send you an estimated sort of K-1 or whatever information it is you're waiting on. And you have to sit down, and you still really have to go through the exercise of doing your taxes and figuring out what it is you're going to owe. And you have to mail that check in by April 15th. So even though you're getting an extension to file, it is not an extension to pay. You still have to pay your taxes on April 15th. You have to do a very good job of estimating what it is you owe and paying it. I personally tend to overpay it in case I'm surprised with slightly different information after it comes in.
I wanted to ask you that question. It would make more sense to overpay than
Well, personally for me, yes, it makes more sense to overpay it, because what happens is if you don't send in all the money, let's just say you eventually filed come October 15th, and let's say you sent in a check for $1,000, but it turns out you owed $1,500, okay? Well then starting on April 15th, you're gonna owe a penalty on $500. You're gonna owe what's called a failure to pay tax, 0.5% for every month it goes, plus they're gonna charge you interest on top of it, okay? So yes, you may get yourself an extension to file, but don't be fooled, you still have to pay your taxes by April 15th. Yes, you have to sit down and estimate and go through the whole exercise, pain in the butt, and then I have to do it again, come September or October when I'm really ready to file.
So what if you overpay, but the amount of the year you owe this, you're gonna get that as a credit, or?
If you overpay it, they'll give you the money back. You just file for the refund at that point. If you underpay it, then you're gonna have to send in the difference, and you're gonna owe a failure to pay penalty, the clock starts ticking on the failure to pay as of April 15th, and they're gonna also charge you interest starting as of April 15th, okay? The book also mentions, guys, this isn't super important, but look, if your due date is, whether it's your original due date or your extension due date falls on a Saturday, a Sunday, a holiday, then you just file as of the next business day. We'll just walk through one of these just to see. Okay, so we went through the due dates, we went through the extension dates. If I said to you guys, I have a partnership, okay, and they have a fiscal year end of June 30th, okay, and they file an extension, what day would they have to file that?
Repeat the question.
What?
Can you repeat the question?
Sure. I have a partnership. They have a fiscal year end of June 30th. And they have to file their taxes, but they file an extension. By what day do they have to file their taxes if they requested and received an extension?
October 15th,
Sorry.
October 15th.
Well, they have an extension.
September would be 5 months after. Okay, yeah, you're right.
I'm gonna go March 15th, okay? First they have to file by the 15th day of the 4th month. So we're at the end of June, okay? So we're gonna take 3 more months plus 15 days from there. So June, end of July, end of August, end of September, October 15th. That would have been their original due date for their taxes, okay? Then they get 5 more months from there. So we're in mid-October to November, December, January, February, March. So we would be March 15th by the time okay? Their original due date would have been October 15th plus 5 months for the extension. And that would have brought them into March 15th of the next year. Okay? Sure. So they started with a fiscal year end, this is when they closed their books. Because it's a partnership, they have to file their original return on the 15th day of the 4th month after that. So really it's 3.5 months. Okay, it's 15th day of the 4th month. So you could count 4 months out. You could say 10/30, but then subtract 15 and take it back to October 15th, or you could just add on 3.5. So that would be their original due date. This would be the date, if they didn't file an extension, they would have had to send it in by. But then partnerships get an extra 5-month extension, okay? And that would bring it out to March 15th for the next year.
So basically, it's the same, if you file for an extension, either on a corporation or a partnership, your extension will be the same.
No, corporations get 6 months like an individual.
Yeah.
Partnerships only get 5. It's a, go ahead.
When you file for an extension,
Yeah.
you get 6 months for the corporation or 5 months for the partnership.
Partnership.
I think that isn't the same.
It would work out to be because corporations on the original due date would be 1 month sooner, so they get the extra month. So if this is a corporation, yes, it would work out at the end of the day and be the same. You guys good? Okay, due dates, extension dates, guys, important again, okay? This is, day-to-day information, go ahead.
So is the penalty, do they still get the penalty the same as an individual? Like if they don't?
Yes, if they don't, if they don't pay on time, look, everyone's clock is gonna start ticking as of their original due date for the failure to pay penalty. Okay, there's no extension in paying. So whatever your original due date is, that's when you have to pay by, whether or not you file an extension. The failure to file penalty, okay, so if you ask for an extension and you got the extension, let's say you're in this partnership, and you didn't file by March 15th, then your failure to file penalty would start here, okay? If you didn't receive an extension or you didn't ask for an extension, your failure to file would start here with your failure to pay.
Is that a 15 or next people too?
Partnership is my short now.
Alright. So for partnerships, right, they have to file on April 15th.
Don't say April 15th though. If they had a calendar year end, yes, it would be April 15th. But again, if they have a fiscal year right? Because this company ended at the end of June. But we know that, okay, so they closed their books on June 30th, and the rule reads that for partnerships, they had until the 15th day of the 4th month to file their taxes. So that's why we said, technically, their due date would be October 15th. Okay? But this company went further and said, you know what, we want an extension. So a partnership gets a 5-month extension. So that may go up and on to here. But if they didn't request the extension, this is when they would have to file that, October.
So even though they're filing extension, they still have to pay by.
Their check has to go in here, always. Always your check has to go in by the original due date, okay? And if you don't send your money in by this day, the interest starts running here, and the failure to pay starts running here. If you don't file, it depends on whether or not you ask for an extension. If you didn't ask for an extension, your failure to file will start here as well. If you did request an extension and for whatever reason still don't turn in the tax return by this date, your failure to file will start running here, okay? One is paying is always on the original due date, one is filing, and that depends on whether or not you ask for an extension. Okay? You good? Okay. So guys, after you turn in your tax returns, there's this period of time called the statute of limitations, okay? And what this means is that there is a period whereby if you notice you made a mistake in your tax return, or the IRS looks at your tax return and there's adjustments to be made, it is incumbent on you to file an amended return. And it is also incumbent on the IRS to notify you that there's a mistake in your return. And this is whether or not the mistake is in your favor or against you. Okay, so if you notice a mistake, you're supposed to go and file an amended return and send in the money. If you notice something in favor, obviously you're gonna file for a refund anyway. But if the IRS audits you and they notice a mistake, they are, obviously, if it's in their favor, they're gonna let you know. But even there's cases where they found a mistake in your favor, you're probably gonna get a check, okay? But this period of time is called the statute of limitations. And the statute of limitations says that the period of time, this 3-year period, starts from the later of the original due date of the return, okay? Or the date you actually filed, okay? That's an important date, okay? Statute of limitations starts running 3 years from the later of the original due date of your return. So for most of us, that's April 15th. Or the day you actually filed, whichever is later, okay? So here, well, for these, we'll just talk about individuals, and we're gonna be on a calendar year. So let's say I filed my tax returns on April 15th. Okay, when is my statute of limitations gonna close? When can the IRS not come back to me anymore and audit me? At what point does that stop? Go ahead, what?
Repeat them, sorry.
Okay, I'm an individual taxpayer, and I file my tax returns, I'm early. I file on March 15th, okay? I wanna know, at what point does the statute of limitations expire? At what point can the IRS no longer come back to me and say, oh, you made a mistake on your return, you owe us another $1,000? I'm sorry? 3 years. Okay, it's 3 years of the later of the original due date of my return, okay, which is April 15th, or the day I actually filed. Okay, the later of those two. So in this case, right, it's gonna be April 15th. Don't just assume it's 1 year later or 3 years later. Sorry, we'll say this is 15 and this is therefore 18. But
If they end up owing money, like say 2.5 years later, are they going to have to pay the interest and the 25%?
you won't get, they won't pay a penalty, but they probably, in that case, they probably will pay you interest. But they don't pay penalties.
No, I'm saying like the individual, say, like say I file and then 2.5 years later, I owe.
You notice that you owe them money.
Right.
Yes, and it goes back to April 15th of the original due date. So your clock would have been running for 2.5 years at that point. What we'll learn when we get later into the chapter with the failure to file, failure to pay is one of them stopped after 5 months, one of them goes for 50 months. So there is a point at which it stops, but the interest keeps running.
So after the statute of limitations is up, they find a mistake, they can't.
That's it, close to close, okay? So let's again assume that I am a taxpayer and an individual, and I have a calendar year, it's just me. And let's just say I forgot to file my tax return, and I finally get around to doing it on April 15th this year, okay? I just forgot to do my taxes this year. I didn't ask for an extension, I just forgot, and I did it eventually on April 15th. At what point is my tax closing? What time is that statute of limitations closing? Right, in this case, it's gonna be 3 years from here, right? Because again, it'll be the original due date, 3 years from the original due date, or later. So in that case, it'll be 8/15/18, okay? They're gonna give themselves the most time they can. So in this case, they're gonna take it from when I actually filed. They're not gonna go back 4 months earlier, okay? Let's say, same thing, I'm an individual taxpayer, calendar year. I requested an extension now this time, okay? I requested an extension, and then I got around to filing my taxes on April 15th. Same thing, doesn't matter that I asked for an extension or not, okay? It's 3 years, go through the exercise of the original due date, or later, 8/15/18, okay? Okay, important. So 3 years is our general rule, okay? That's the general statute of limitations, but there's 2 exceptions to the rule, okay? The first one says that, look, if you as a taxpayer understate the amount of gross income, okay, again, focus, gross income, not taxable income. If you underreport the gross income by more than 25% on the tax return you mail in, then your statute of limitations just became 6 years instead of 3 years, okay? You understate the gross income by more than 25%, your statute of limitations just became 6 years. So, let's just say I actually reported on the return I sent in $100,000 of gross income, but I should have reported $130,000 gross income, okay? So I messed up. I forgot to put $30,000, okay? This $30,000 over this is 23.7%. Obviously on this it's 30%. Is my statute of limitations 6 years or no? Okay, the rule says if I understate my income, my gross income, by more than 25% of the amount of the return I sent in, of what I reported, then my statute of limitations becomes 6 years. Sorry?
So you don't have to, you don't get 6 years?
No, I'm okay. It's $30,000. I should have reported 130. I only reported 100, but 30 over. Let's do this out. I do this backwards. I did it.
Yeah.
Did it backwards. Sorry, you guys.
So now it's yes.
Yes. 23.7. Yes. Okay. Because you have to look at the number. What did I send in? What did I say? Was it 25% of that number? Don't look and say, oh, I should have reported 130 and the difference over what I should have reported. It's not this number, you're looking at this number. What did I put on the return amount then? Is it more than 25% of that? Okay? Because a lot of people will naturally go to this number, it just seems more intuitive to go to this number, but don't. What did I mail in? That's what they're gonna base it off of.
You said greater than or equal to 25%?
25%. Yep.
That's a yes, right?
Yes, yes, because he only reported 100, he should have reported 130, so he's off by 30%. The point being is that a lot of people would say, oh, well, I should have reported 130, and 30 over 130 is only 23%, so I'm safe. You're not safe, okay? Okay, so that's the second exception, okay? Looking at the gross income to see, did I underreport it by 25%? The last exception says that if you commit fraud, or you don't file a tax return, okay, there is no statute of limitations. It stays open forever, okay? So if you commit fraud, then they can come back to you at any point in time, 15 years, 20 years, whatever it is, okay? They can go back and dig up tax returns from way back when. If you don't send in a tax return and you were supposed to, your statute of limitations stays open. There's nothing stopping them from going back and assessing you for, 10 years, 15 years of returns that you owe, okay? So, again, guys, this is all, everything we've done up to now, really day-to-day, vital, important, basic tax information that you really should know, okay? Definitely focus on that stuff and know that stuff really well. Okay, so we're talking about when they can come back and audit you. Well, how do they select you for an audit, okay? I mean, the fact is guys, there's no really hard and fast rules about how they can pick you for an audit. They can really, they can't like go after certain people, even though we've probably seen it in the news that maybe they have targeted some people, but they're not allowed to do that. But they can use a variety of sources. There's no rules that say how they can go about determining. Nowadays with like Sarbanes-Oxley, we see all these companies have whistleblower rules in place. Most of these public companies have to have formal whistleblowing procedures in place. They're taking that very seriously, and that's how they're getting a lot of information. Could be disgruntled employees, could be an ex-wife, ex-husband. They could read something in the newspaper. So-and-so died and they left this estate and, gazillions of dollars. Well, did they file a return? Really they go about this in any sort of way. They may decide to target in any given year a certain industry. They may say, we've had some problems in this industry we're noticing, so we're going to audit a lot of taxpayers within this industry. They may go after taxpayers engaging in certain types of deductions or tax shelters, okay? Sort of questionable, complex areas that they think there's a good chance that the numbers are going to be wrong. They're going to target those, okay? But the book does bring up 3 sort of main systems that they use on virtually all returns, okay? The first one, the DIF system, the discriminant function system. What this system does, guys, is it takes the tax returns when they come in and it assigns every tax return a score. And the higher your score, the more likely that you're going to get selected for audit, okay? This system uses data from this national research program. The National Research Program goes out and it just randomly selects a bunch of different tax returns. They look at the results of the audits of these returns to see where are we having problems. Are there common deductions? Are there issues with a certain type of deduction? Like, controversial deduction has always been home office deduction. It tends to get abused by people. People are very liberal with it. So possibly if you're taking a home office deduction, they're going to put a little flag on your return for that. They may look for things like, hey, you gave $5,000 in charitable contributions, but you only earned $10,000 in income this year. How'd you manage that? Okay, they're going to look for maybe certain ratios that don't really make sense. You're claiming $50,000 property tax deduction again, but your income is only $20,000. They're going to look for certain flags and ratios, things that are not jiving. And they don't share how they come up with this weighting system, how they assign numbers, and that's kind of their secret, behind the screen there. But we know that this is the general method that they use, and certain things are assigned certain weights. And if you have a lot of these things and your points start to add up, well, again, it's going to send off a red, flag. Someone will pull it and look at it, and they may give it a cursory look and say, you know what, this is kind of actually, we can explain this, it makes sense. Or they're going to say, yep, you just got audited, okay? You're now up for audit. That's one of the big systems. All the tax returns are going to go through this document perfection program, okay? This is just a very basic, guys. Does your tax return foot? Do the subschedules flow to the face of the 1040? You ended with $20,000 on the Schedule A. Does that $20,000 carry over to here? Did you calculate the tax rate? Okay, it's just basic, simple. They're double checking what you did on the return. And then the last one is this matching program, guys. We live in the day of computers. It's getting harder and harder to get away and not report things. So not only do we mail in our tax returns, and a lot of us are filing electronically nowadays, which is making it much easier for the IRS. But look, our employers are required to send in our information on our W-2s, okay? They get all of that electronically with our social security numbers. Our banks are sending in our interest, our dividends from our brokers, okay? Our 1099s are all getting electronically sent to the IRS. If you own a home, 1099 1098s, okay? You're getting your interest deductions, whatever property taxes you paid are being reported by your mortgage company. And I can go on, there's, you know, a lot of these different things. And what they're doing is they're taking those records with your social security number and meshing it against your tax return to say, does that number they gave us report to what you're actually putting on your tax return? If they don't match, it's gonna get kicked out, okay? And it's gonna go up for audit. So this is the system. Alimony is another one I'll throw in there. We'll see, we'll learn that, you know, person paying alimony can claim it as a deduction, and they actually put the spouse's social security number right on their tax return, and then you have to, on the other side, report that alimony. Again, if it's not gonna match, it's gonna get kicked out, guys, okay? This is the matching program, okay? So that's another way that they're gonna sort of go about auditing you. And again, all tax returns are going through this, okay? Just on a sort of side note, which I always thought was interesting, is when I was in grad school, one of my professors had a friend of his who works for the IRS come in. He works for the, he's a special agent. He works for the Criminal Investigation Division of the IRS, and they actually carry guns, which I always found kind of weird, but they do. But he was telling an interesting story about, you know, when they find maybe that certain sectors aren't willingly, you know, filing, or maybe they're not fully reporting, particularly like cash basis industries, they may plant actually stories in the media. The IRS may, you know, make an example of one person that they went in and, you know, they did an audit on them, and, you know, they're in trouble and they're going to pay these fines and these penalties and this interest, and will make a point of putting it in the local media all over, placing it, and so that hopefully other people working in the same industry are saying to themselves, ew, you know, maybe we should, you know, file. They're trying to get people in there to file. And again, he was mentioning particularly things like cash industries. I mean, what comes to mind to me is maybe things like I own a home, so landscapers. A lot of landscapers are still looking for cash. Cleaning service. I know anyone I've ever had clean for me is always looking for cash. So they may target some of these companies knowing that they're collecting a lot of cash and probably aren't reporting a lot of it. So again, they may go out of their way to put, you know, audit a couple of these and then kind of make a headline in the newspapers to kind of get enforced compliance, or voluntarily that way. I always thought that was interesting. So, okay, we good up to here? This is not the most interesting information, I know, I'm sorry. So, what types of audits are there, okay? Look guys, I mean, the most simple audit is called the correspondence audit, and it is just that, and it is literally, you're gonna receive a letter saying, you know, this, you know, particularly if you come out of the matching program, or maybe something doesn't foot on your tax return, they're gonna say, you made a mathematical error, you recalculated your taxes, you owe this amount. Or your, you know, mortgage company said that you only had deductible interest of $14,000, you reported $15,000, can you please explain this? And usually you'll just write back explaining why, or oops, made a mistake, sorry, here's my check. And it's generally going to be something as simple as that. Or if it's something more complex, maybe there's a couple of issues involved, or maybe it's a more complex deduction that, you know, you can't just resolve quickly by mail. You may get called in for an office audit, okay? And you will get a letter in the mail saying you've been selected for audit, here's the items at question, please bring yourself, your files, you could bring your tax, you know, accountant or your lawyer if you would like to the meeting, and basically you'll sit down in the room and kind of count this out and work through it, and, you know, hopefully resolve the issues. Much less common, the most common by far is going to be the correspondence audit. And then the last one really, guys, is the field exam. This is when they're coming to you, okay? And it probably sounds awful, but the fact is there's a lot of, especially like your big Fortune 500 companies, if anyone's ever worked for those companies, they've probably seen, these auditors basically are there, you know, year round. They almost never leave, because these companies are so big that, you know, by the time they finish the audit, they're starting the next year's audit. So for some companies, it's very routine to have the IRS basically on site with them full time. If it's not routine for you, it may be more of a problem, okay? Because maybe they think something's going on, and now the fact is they want to come to your offices, they want to be on site with the document, they're not going to allow you time to say, oh, let me find that document. Like, they're going to walk into your office and say, I'd like to see invoice, you know, XYZ now. Or they want access to your staff, because they want to walk in and look the staff in the eye and say, I had a question about this, can you tell me? They're not going to allow you a lot of time to kind of come up with answers and documents and reasons. They want to be there, they physically want to see the document, quickly, they wanna talk to you, have access to the right people without having to go through a bunch of different people. So, a field exam could be, a lot more hairy, but not always again, because again, most corporations that have these people on staff, they're gonna be there year round. It's a very common thing. I will point out, because this has come up in the past, you will never get an email from the IRS saying, hey, you've been selected for audit. So if you can just log on to this website, that doesn't happen. And I've seen those emails personally. You will never get a phone call, at least not initially, from the IRS. And I've gotten those a couple of times 2 years ago, with someone saying, this is the IRS, and we have questions about your return. You need to call this number. It sounds very serious, and they sound really angry. That will never happen. Okay, the first contact is always going to come in a written letter. It's going to introduce the agent. It's going to provide their number. It's going to tell you, when and where to contact them. They may initially follow up with a phone call, but the first introduction will always come in a letter. Okay, so I've had people ask, it will never come in a phone call. It will never be in an email. Okay. Okay. So you went through an audit, or you've been selected for an audit. Now what happens? Okay, what's the process? Okay, so maybe it's a correspondence audit. Maybe you go to them. Okay, at the end of the audit, and let me start by saying, the audit, the initial person. Did you have a question? Okay. The initial person you meet with is called the examination officer. Okay, this is the first person you're going to go in and work with, and kind of figure out what the right answer is. At the end of the audit, they present you with what's called a Form 870. Okay, this is the list of audit adjustments. This is what they think the tax return should look like. This is the additional amount, probably, that you owe, maybe that they owe you, but more than likely that you owe. Okay, and they're going to present you with this Form 870, and ideally, they would like you to sign it and give them their check, not just for the difference, but again, probably for penalties and interest as well. Okay. But the fact is you do not have to sign that Form 870. Maybe you don't agree with it. So what do? Okay, if you don't want to sign the 870, you then basically wait for what's called a 30-day letter. You will receive an official 30-day letter in the mail. And this means that you have 30 days to either concede and pay it, or you're requesting to meet with an appeals officer. Okay. So the first level, the initial audit, is done with an examination officer. But now you want to meet with an appeals officer, okay? Now, in theory, an appeals officer is completely independent of the examination officer, okay? They don't report to each other, they really don't talk to each other. So this is supposed to be someone removed from the situation, independent, have no bias, okay? Now, an appeals officer, guys, he has more authority than the examination officer, okay? The examination officer basically just kind of looks at the letter of the law, the tax code, looks at what you did, and applies the law appropriately, or at least as he believes it to be appropriate. Now, when you go into an appeals officer, he has more room to move, okay? He can actually look at it and say, you know what, I think I'm right, and I think the IRS is right in its position, but it's going to cost too much to take this to court if we end up going to court. So we're just going to let it go. Or he may negotiate with you and say, let's meet in the middle. You can kind of work out a number with him. He may look at it and say, you know what, I have a pretty good chance of losing this when I go to court, so I'm just not going to pursue it. Or he may say, you know what, this is an important point. I don't want to set the wrong precedent. So even though maybe it's going to cost the IRS a lot to go to court, we're going to see this through. Because I don't want to set the wrong precedent, because then other taxpayers are going to follow this, and that's not what we want to happen, okay? He can use what are called the hazards of litigation. The examination officer cannot do that, okay? The appeals officer has room to negotiate. He can look at the merits of the case and decide whether or not he thinks it's worth it to kind of push through. Maybe he wants to negotiate with you. Maybe he doesn't. Maybe he says, you know what, let's go to court, okay? That's his right. He can do that. So, go ahead.
What was the hazards of
Litigation. He can use the hazards of litigation.
Would you say who used it?
The appeals officer can use that. He's the second person you meet with, if you choose to, okay? You go to appeal, he can use the hazards of litigation. He has more authority. Form 870. His is actually called a Form 870 AD. I'm not sure the book makes that distinction. It's 870 Appeals Division. But again, he's going to present you with his Form 870 and saying, these are your audit adjustments. You know, he wants you to sign it and pay it with your interest, with your penalties. You may say, sorry, still disagree. No. So at that point, you are now waiting for what's called a 90-day letter. It is also called a statutory notice of deficiency or a ticket to tax court. Okay? You're waiting for this 90-day letter, and what this 90-day letter does is it allows you to now go into court and sue the IRS. Or you can concede and sign it and pay the penalties. But you have 90 days to file this. What I will point out, guys, is, and this isn't in the book, anytime you deal with a federal agency, they have what's called the exhaustion of administrative remedies. And this basically means that if you want to take them to court, like this taxpayer may do now, you have to follow their process, okay? You have to go through the audit, you have to meet with the exam auditor, you have to wait for your 30-day letter, then you have to apply for the appeal. You have to meet with the appeals officer. If you don't agree with him, then you have to wait for your 90-day letter. You can't just say, you know what, I met with the auditor, the original auditor, the examination officer, he's a jerk, he's biased, he's just being, you know, mean because he can be, you know, so I'm just gonna sue the IRS. You can't do that. You have to, and this is any federal administrative agency, you have to go work the process, okay? And this is called, again, the exhaustion of administrative remedies. Okay, so there's no way around this. You've got to work your channels if you want to take them to court. Okay, so now getting back to our taxpayer, okay? He's got his 90-day letter in hand, so now he, if he wants to, again, he can pay the taxes and just say, you know what, it's not worth it, or he can go to tax court. He can now file a case. Now look, this is initially they say to the tax court, but there's actually 3 levels of court, and you can kind of determine which court you want to go into. If you go to the tax court, okay, now we're going to get into our courts. The tax court is a national court, and it's made up only of tax experts. This is what they do. They know the law pretty much better than anyone. They only hear tax cases, okay? But you also have the option of going to 2 different courts. You can go to a district court, or if you wanted to, you can go to a federal court of claims. You don't have to go to the tax court. Now, how do you choose one court over another? I mean, the fact is, guys, if you're going this far, you probably have a tax advisor. More than likely, you have an attorney at this point, and they're going to help you with this. But nonetheless, I mean, look, this is what you're going to be looking at. Is the first thing is, do I have money to pay the tax in question, the penalty, the interest up front or not, okay? The tax court, you don't have to pay anything up front, okay? You can go on there owing the IRS money, and basically they're suing you for the money, okay? But you can file the claim without having paid all of this up front, okay? If you want to go into a district court, or if you want to go into the federal court of claims, you need to pony up. You need to pay all of this money up front, then you need to file for a refund, and when the IRS basically denies your refund, you're suing them to get it back, okay? So if you want to get into a district court or the federal court of claims, you're going to have to pay everything up front, and you're going to be fighting to get it back. Okay, so some people might prefer the tax court because they may not have the money to do this, okay?
For the tax court, what do you file for, like, $50,000 on that, right?
There's a small claims court that goes underneath the tax court, but no, you're not limited to just $50,000. There's a small claims court where if your case involves amounts of less than $50,000, you can go to the small claims court. It's less involved.
Looks like one of the courts uses it, jury, which one?
Well, that's what we'll get into. That's actually our next point. So, you may want to look at basically the technical merits of your case, okay? This may be another decision is, look, I know I have a really good case. I'm a tax practitioner myself. I know what I'm doing. I disagree with the IRS. I know that I have a solid case. You may then want to go to the tax court, because if you feel like you know what you're doing, and then you're going to want to go to the guys who, the jury, who knows what they're doing as well. You may want to go to the tax court, because again, this is all they do. They only hear tax cases, and they know the tax law. If you don't feel like maybe you have the best technical case, but maybe you have something that's high on sympathy, you're a single mom, maybe you can work the jury a bit, then you're going to want to go to the district court, okay? Because the district court, you can get a jury, okay? So maybe not the most technically sound case, but maybe you feel like you can work some heartstrings. You might want to go to the district court. But again, you have to have the money to do that. And then really, very important, what you're going to want to look at and see is, well, have these courts, these 3 courts, heard similar cases, and how did they rule? If there's a case out there very similar to mine, what did the courts before me say? How did they rule? In my favor, against me? And you don't just want to look at these 3 courts, you want to look at the courts that they appeal to, okay? Because the lower courts have to follow the rulings of the courts that they appeal to. So again, your lawyer is more than likely looking to say, okay, there's similar cases out there. This court ruled in your favor, this one didn't rule in your favor, so we're going to go here, obviously, where they ruled for a very similar case. So these are the things you're looking for, okay, when you do get to a court system, which court you want to enter into. Look, the fact is, guys, for most tax cases, the appeals level is where the cases stop. You can try to get into the Supreme Court. The Supreme Court hears something like 75 cases a year, and then I think without a jury trial, it could take like another 50 or 60 cases a year. So they may take somewhere between like 125 to 150 cases a year, out of like about 10,000, I think, on average, are sent in each year. So they're really only picking tax cases that have sort of very broad implications, or maybe they're going to take a case where they have 2 major courts of appeal kind of in conflict to resolve it once and for all. But for the most part, you're not going to go looking too much above the Court of Appeals, okay? Because that's usually where the tax cases are going to end. Okay. So now we're talking about audits. We're talking about having to go to court. Okay. The fact is, what is the tax law? If I'm going into court, what should I be looking at? There's a lot of information out there. What is authority? What can I go into court and say, well, the law says this. Where am I looking for this information? If I do have to go into court, or I do have to face the IRS auditor, what can I cite as authority? Again, there's a ton of information out there, but the fact is very little of it can you actually, if you're going to go into one of these situations where you're going to go into an audit with the IRS, or even worse, you're going to end up in a courtroom, you have to make sure that you have the right support, otherwise you're going to lose your case before you even walk in the door. So this gets into this tax law sources, and the book divides it into primary sources of authority and secondary sources of authority. Now, our primary source of authority is obviously what we're looking for. This is what we want to have. This is what we need on our side. This is the official law, okay? If I go in and cite these things, they're going to respect what I'm having to say. The secondary sources of authority, guys, look, these are good things. They're helpful. A lot of times they use plain English to explain, very thick legalese. They're there to help us interpret the law, but you cannot use them as authority. You cannot cite them in a case, okay? Because they'll just say that doesn't mean anything. That who wrote that? Your textbook author? He's not. No, okay. If you look in the book, it's page 210 and 211. They give you 2 sort of charts. The first page is a page of primary authority, which you guys don't have to remember all this. It's not super important. But what I will point out, guys, what to look at that's not authority this is always interesting, is that, look, the IRS, I don't know how many of you have actually done a tax return or seen, okay, the IRS doesn't just publish forms, but they also publish tons of publications, and they're detailed how to, calculate, how to do these things. Believe it or not, even though these are coming from the IRS and they're there to help you prepare your returns, they are not sources of authority, okay? So you can't go into court and say, well, I used the IRS publication and I did exactly what you told me to do. It's not authority, believe it or not, okay? I know I shouldn't have to say this, but I've seen a lot of people turn in tax research papers, guys. Google, Wikipedia, again, helpful, a lot of good information, but you cannot cite things like Google and Wikipedia. I know you know that. But you'd be surprised how many people do, okay? TurboTax, okay? Here's a software product, very widely used, probably one of the biggest names for, home use. You can't go in and say, TurboTax calculated it. That is not defense, okay? story from 2009. I don't know how many of you are aware. Do you know who Tim Geithner is? No one? Okay. He was, you know who Timothy Geithner was? Okay. He became the Secretary of the Treasury. Okay, so he became the head of a very large, very powerful administrative agency back in the early 2009 to 2013, I believe he served. And what happened is that in the course of his confirmation hearings, it kind of came to light that he had some issues with the IRS from a few years before. He had failed to pay about $35,000 worth of taxes. And his excuse was, well, TurboTaxed it. And look, I mean, here's the guy running the Secretary of Treasury. He's responsible for the IRS. You know, with TurboTax, it doesn't work. Okay, it's not. You can't go in and say, well, TurboTax did it. TurboTax calculated. As well respected as it is, as good as it is, you know, TurboTax is not an excuse. Okay, it's not an authority. Okay.
Was that why you had to step down?
No, he ended up just leaving on his own. But no, the media was all over him when it happened because you know he's the head of the Treasury, and you know the IRS is a bureau within the Treasury, and you know I know the media were all over him saying, well, hopefully you know running the Treasury is a lot easier than running TurboTax. But the point being, look, even if it's something like TurboTax and you got into an audit, you can't go around saying, well, I used TurboTax and you know it calculated it wrong. It's just not going to work. You're going to lose. Okay. I'm going to start this. I'm not going to get too far. Going back to what primary authority is, because that's really what we're after. Look, guys, I'm going to tell you the primary authority. It's not just important to understand the difference between what is primary and what is not primary, but when you're looking within primary, you want to understand sort of the pecking order. And there's no hard and fast, like this is the most absolute and this is the least. But you want to get a feel for what is the most authoritative, kind of running down to what's less authoritative. Because the fact is you're going to your tax accountant, okay, and look, most tax accountants know the day-to-day stuff. They don't even have to think about it at this point. But if you're going to him with a bit of a unique situation, and he has to kind of figure out how to treat this, you know, he needs to understand, you know, what is he going to look at? What authority is he using, okay? You know, if he's using like very minor authority, but yet there's some stronger authority out there that goes against the position, you may not have such a good case, okay? So you could have two pieces of authority, one for you, one against you. You got to kind of look at the stronger of the two authorities. There may be a lot of authority out there. Now you're in a position of saying, okay, well, this came from the Supreme Court, this came from, you know, the IRS. So it's important to have a feel for the pecking order of the authority, not just distinguishing between what is true authority and what is not. Okay. So our primary authority, guys, comes from all three different branches of our government. Okay. And we're going to start by looking at the legislative branch. Okay. So obviously our legislature is responsible for maintenance of the Constitution, and the Constitution being the supreme law of this country. Now there's not a lot of tax authority, we've talked about this, within the Constitution. The only item is really the 16th Amendment, which I told you came about and gave Congress the right to lay a direct tax for income tax purposes. But apart from that, within the Constitution, there's really no tax laws, so not a lot to look for there. The legislature is also responsible for tax treaties, okay? Tax treaties are law, and they are issued by Congress. And what they are really, guys, though, is they pertain to international taxes. So the United States and another country will voluntarily come together and negotiate tax treaties. And what they're really trying to do is foster trade between the two countries, okay? Because what happens is, as a United States citizen or resident, because we provide you with certain privileges and rights and our protections, we are entitled to tax your worldwide income, okay? So as long as you're a citizen in this country, let's just say you go to London this past summer and you worked in London, you earned $100,000. Well, as your home country, I have the right to tax that $100,000. The United States does, okay? Well, guess what? England is also going to want their share, right? Of course. So now you have two full sets of taxes. Who in their right mind would go work for, 10% return? So without the tax treaties, you would have this issue of double taxation. What the tax treaties do is they negotiate between the two countries. They may do things like say, okay, well, if it's service income, London will get it. If it's interest income, the United States can claim it. Or they may say, we'll both tax it, but we'll both tax it at a reduced rate. Okay, there's a lot of different variations of the way they can set these things up. But the idea is that they're going to alleviate this double taxation. It provides taxpayers with a level of certainty, knowing when they're going in, okay, here's what I'm going to be subject to. And it encourages us all to do business together that way. Okay, those are the tax treaties. Again, unless you have international dealings, you don't really have to be too concerned with the tax treaties. Okay, but Congress is responsible for those. Where the real money is, okay, is Congress issues the Internal Revenue Code. They maintain the Internal Revenue Code. They come up with the laws, okay? And the Internal Revenue Code is the law, okay? This is the tax law. It is issued by Congress. And quite frankly, I mean, they're kind of right up there with tax treaties, but tax treaties, again, are international. For United States purposes, for our purposes, the Internal Revenue Code is the main authority, okay? This is probably going to be your highest level of authority. The book puts Supreme Court rulings right up there with tax treaties and the Internal Revenue Code. They kind of have all three on par with each other as being the highest authority. I would make the argument that maybe the Supreme Court rulings are slightly down from the Internal Revenue Code and the tax treaties for this reason, okay? The Supreme Court can't make the law. All they can do is interpret the law, okay? They can declare something unconstitutional, but as long as something is constitutional, whether or not the Supreme Court likes that law, all they can do is interpret it, okay? So I don't know that I personally would say the Supreme Court is on par with the Internal Revenue Code. I would probably just put them a notch down in this.
This is still primary authority though?
Primary authority, yeah. So I would say, your Internal Revenue Code for our purposes is really going to be your absolute primary authority. That's going to be your highest level. Look, guys, I mean, the book kind of gets into the whole process of how, a bill becomes an act becomes a law. It's interesting. I mean, maybe give it a quick read, but, I don't think it's overly relevant to this class. What I will say and point out is that within the process, as the bill is kind of working its way through the House, and then as it gets to the Senate Finance Committee, okay, in the course of these discussions about what the law should look like and, eventually how it ultimately develops, there are constant committee notes. And you'll see on the chart with the notes that they have, committee reports, Senate Finance Committee reports, House Ways and Means Committee reports, okay, they're keeping notes. Those committee reports are a very important source of authoritative authority, because what they're doing is look, when the code finally comes out, the code tends to be very broad and all-encompassing. They're trying to capture the entire audience. So the code tends to be, I don't want to say vague, but it tends to be broad, okay? And there's a lot of room to interpret and wiggle room. So more often than not, if you end up in court, and if you start reading court cases, tax court cases, what you'll see is that the courts will go back to these committee notes and say, okay, we see what's written in the code, but what do they mean? Who are they really trying to tax? How are they trying to tax them? What was the true intention? And they'll go back to these committee notes, because as this law is taking form, you have the different representatives, senators debating, well, here's what we're trying to do. So they'll go back to the committee notes and really try to figure out, well, what did you really mean when you wrote this law? And it's very, very, very common. So those are very powerful sources of authority. Look, I mean, the book also gets into the organization of the code. Since we're not really working with it, I don't think it's terribly important for you guys. What I will tell you is that, look, when you go to grad school, they hand you a book that's, looks something like this. And I will tell you, this is only I think they said if you lined up 16 of these, that might be the tax code. So this is only a fraction of what's out there. And you'll see if I showed you the book. I mean, the paper itself is virtually like tissue paper, and you see how small the writing is, okay? So the tax code is this massive, massive monster of a thing. But what the book is trying to point out is, look, it is organized logically, and if you start working with it, you will see how it's sort of structured, okay? It's broken into chapters and then subchapters, and a lot of you will have heard terms like, subchapter C, okay? So within subchapter C, which is really the 300 series, we're dealing with corporate, the rules pertaining to corporations. Subchapter K deals with the rules pertaining to partnerships. And then even within then, you break it down, like you learn where certain things are sort of organized, okay? And then you learn how the codes themselves are structured. You know, typically if I cite a code section, the code section will start off with a very broad, general rule, okay? But then if you work your way down from there, the next thing might be, so the next thing might be an exception. Then the next part of it might be an exception to that exception. You learn over time sort of how things are structured, where to locate them. So as big as it is actually very, very manageable, and I think that's really